title of the presentation is "Who Cares?" That's slightly tongue-in-cheek, as I often am. When I say "Who cares?" what I'm really saying here is anyone who, of course, has been following the markets. There's been this enormous disconnect, or it certainly appears to me as an enormous disconnect between the hard news that we're getting from the economy, the economic metrics, which are spectacularly bad and in fact getting worse, not better. Against that, you've got equity markets that have already, certainly the big market and certainly on Wall Street, has already seen a huge bounce. You've seen about a 60% retracement of the loss for the S&P and over 70% for NASDAQ, which is pretty amazing when you think of what's going on out there. You know, here's a graphic representation of the S&P. This is sort of as of yesterday's. You know, essentially, it's funny. You know, a lot of people that I know in the financial service business, it's kind of fashionable to dump on the Fed and talk about how horrible they are and what a terrible job they do. But the truth of the matter is, the Fed really, more than any other entity, is. Oh, just hang on a second here, folks. I mean, essentially, this is a graphic representation of what I'm sure you've all heard for years, referred to as the Fed put. And I think that's as good a term for it as any, in the midst of really one of the worst economic contractions in at least 80 years. And it's quite possible it's actually going to be worse than the Depression in terms of amplitude. You saw the S&P get down to just below 2,200. It's already bounced all the way up to the mid 2,900s. Which is pretty amazing given how horrible the numbers are in the broader economies. We got another 3.4 million initial jobless claims in the U.S. today, so we're up to about 30 million, which is a mind-boggling number. Technically, it's a bull market again. The market's gone up on Wall Street 34% since the bottom. That seems to have a lot of people bullish. It's actually quite amazing, the level of complacency in the market. It's amazing to me anyway. The complacency in the broad market. You look at the put-call ratio on Wall Street, you look at a lot of the investor sentiment surveys, you look at new accounts and account holdings of sort of strictly retail investment houses like Robinhood. It's really quite amazing how fast and how bullish the outlook got and how quickly the positioning got bullish again. Nobody seems to be terribly worried. Which is a little worrisome to a cynic like me. The real question is, you know, we just take the market as it is. The question is that going to continue? Is the Fed put ultimately going to work? This gives you a sense of what's going on out in the real economy. Again, stepping away from Wall Street for a minute, this came out yesterday. This is the GDP print for Q1 in the States. Keep in mind that the lockdowns in the US and throughout Europe started mid to late March. So essentially this pretty horrible number of minus 4.8%. This is actually before the worst of the lockdown. I expect the next quarter, or the quarter we're in right now, to be significantly more horrendous. If you take a look at this chart, this is a bit more of a current read that you get from Goldman Sachs. It's a monthly rather than a quarterly. So the April reading, which of course wouldn't have been included on the previous slide, you can see it on the right side of the chart. The consensus estimate on Wall Street and by most private sector economists is for a Q2 contraction in GDP of 26%, which is a difficult number to even get your head around. It's never contracted that much. You know, people sort of make the comments like, "My God, it's like the Great Depression." It's actually worse. There was never a quarter in the Great Depression that was that bad. The real question is, how fast does this change? Right now, it seems, if you look at how the market's trading, and if you look at sentiment surveys, there's clearly an expectation that we're going to come out of this quickly. This survey also came out, I believe, yesterday. I find this survey quite interesting because it tells you a lot. I think it tells you pretty much everything you need to know about why the market is trading the way it is. This is a U.S. consumer confidence. There's two readings here. The blue reading is the present situation. So that part of the survey, they're just saying, how's it going? Have you got a job? Are you making payments on time, et cetera, et cetera. That's horrendous. It dropped from basically 160 to about 70 in 1 month. I don't think it's never dropped that much in a single month before. But the overall readings that include expectations and present situation, it also had the worst month ever. But if you look at a long-term chart of it, it's still not that bad, and it's because of the expectations part of the survey, which is the red line. Interestingly enough, that red line actually had a small bounce this month. That tells you essentially the average consumer's expectation is that this situation, as bad as it is not going to last that long. Most consumers completed this survey saying they expect the job market to be significantly better in 6 months, which it might be. I mean, if they're talking April, it probably will be. But this tells you why you're seeing this bounce in the markets, even though the current numbers are so bad. In a nutshell, everyone's expecting this to be over fairly quickly. And of course, the other thing that's been the huge help, as I mentioned at the start here, was the Fed put. And there's two markets here that I think are very good examples of this, because this is really the part of the market the Fed's worried about. They're not buying equities yet, and there's no reason they would, given how the markets are trading. I don't think I'm not sure they'd go there, but who knows? They've gone into all kinds of areas where, strictly speaking, it's not legal for them to be buying. And they're in all kinds of areas where, it's way outside their mandate. But I think if central banks, the Fed being one of them, learned anything during the great financial crisis, it was they didn't move fast enough. And it's pretty obvious. It's pretty obvious the FOMC as a group must have had a bunch of conversations over the last few years about what do we do next time if something like that happens again. And clearly the answer was we jump on it as hard as we can, as fast as we can. And you see that here. I mean, if you look at the TNX on the right, that's the 10-year Treasury yield. It's staying down at about, those readings are, you have to divide them by 10, so that's about 0.6%. Historically low reading, and of course it got down to 0.4 a couple months ago, but 0.6 is still incredibly low. The Fed has kept its promise to keep rates pushed down to the 2 or near the zero bound. The more interesting one, I think, and it generates for me a lot more concern about moral hazards, is the chart on the right is HYG, and that's essentially the high yield bond index. These are the bonds that are sort of just about junk status. A lot of these bonds have been created by sort of S&P 500, Fortune 500 companies. A lot of them are ones that had, less than perfect credit records, less than perfect earnings, and a lot of this debt was raised to turn around and do share buybacks. It's a market because of the obvious moral hazard. When you think about it, management teams raising debt at double B credit ratings in order to buy their own shares back. There's a pretty obvious moral hazard here. A lot of people thought the Fed wouldn't go there. And as it turns out, the Fed did go there. If you take a look at the arrows on that, they show you this huge jump in the HYG index, massive volume. That, I pretty much guarantee you, that volume was the Fed. The Fed stepped into this market, basically said, we'll underpin high yield, we'll underpin junk, we'll underpin mortgage-backed securities. They're basically promising to be the bid under basically every market, and that's why Wall Street's in a relatively good mood. Of course, this doesn't happen for free. All of that market saving comes at a price. What you're looking at here is a graphic representation of the size of the Fed balance sheet. You can see how it had this small, by today's standards, small jump here. This was, TARP, the other programs during the great financial crisis, pushed it up to this level, this sort of rising slope you see here, and then this bigger jump, that's sort of QE1 to QE3. They then tried to get it back down and had some success with it, although the market tended to react quite poorly anytime they really started selling any even reasonable amount of bonds. So they backed off the bond sales several times during this downsloping period. But of course, the big jump is here. And even this isn't really current. It shows 6.5 trillion. It's probably through 7 now. I expect the Fed balance sheet to hit trend 10 trillion this year. That spending is getting matched on the fiscal side, which I think it needs to be, by Washington, Ottawa, every other capital in the G8. I expect we'll probably see U.S. federal deficit between 3 and 4 trillion this year. I think probably more like 4. Everybody's sort of added up the new spending, and that brings you up to around 3. But you also have to take into account that with the economy the way it is, tax receipts are going to basically collapse this year. So I think when you take those two things together, you're probably looking at 4 trillion. These are pretty amazing numbers. I mean, you take what the Fed's adding, you take the fiscal deficits at the federal level, and you're basically talking $10 trillion. That's not a bad thing for us. Us personally, us as guys that are in the gold sector, by and large, in the resource sector. You know, a lot of smart money. This isn't just gold bugs driving the bus here anymore. A lot of smart money, because of, you know, it's not just because of the money supply expansion and deficit expansion. I mean, yeah, definitely there's probably people out there worried about the dollar collapse, if you will. I'm not convinced that's going to happen, and I don't think that's even the main concern. I think you have a lot of smart money traders now saying to themselves, with the numbers we're dealing with, there's going to be some kind of reset. I have no idea what it's going to be, what it's going to look like, what assets are going to be affected. But you can't assume anything in the financial arena is going to be completely immune to whatever this reset is. So they're essentially looking for a non-financial system asset. Really worldwide, given everything's been financialized in the last decade, there's really only a handful of those, and the main one most people know is gold. And you can see the impact that these negative rates, massive ballooning of spending and money supplies had. Gold's having a pretty good year. I mean, back in March, when all these things started unraveling and gold got sold down, I was getting a lot of texts, a lot of emails and calls from subscribers that were freaking out. I mean, I wasn't terribly worried about it at the time. This is actually a classic pattern that you see this sell-off early in a bear market when you're in the what I call a liquidity seeking phase. Basically, if you can sell it, you do. Gold happens to be a big, you know, it is a big asset class. It's a fairly liquid asset class. So like anything that was liquid back then, it got sold. But we've seen a turnaround, and that turnaround really started when you saw the big, essentially the first big monetary packages being rolled out, but they were very quickly followed by fiscal packages. You know, the $2 trillion bailout, the Fed saying we're going to underwrite everything. It's actually much like the great financial crisis. The move in gold that ultimately went for 3 or 4 years really started when they unrolled TARP in early 2009. That's actually when gold really started to move, really started to take off. And I think we're seeing a similar pattern here. I've got no reason to expect it's going to be any different. One thing, of course, that came up when gold started to move was, you know, there were a lot of people who were frustrated because they weren't seeing that move in gold stocks, and we're still not seeing it in all of them. One thing to remember, though, if you think back to the gold on the previous slide there, you can see here where it passes through the previous high from the last few years. If you look at the chart here, there's a bit of a delay with GDX, which is the larger gold miners in the gold miners index, but it did ultimately, in the last couple of weeks, get through the previous March high. We're now at new highs. GXJ, again, sort of one step down the size range, one step down the food chain, if you will. It still hasn't gotten to the March high. I expect it probably will over the next 2 or 3 weeks. And again, if you step yet further down, sort of into the junior arena, which is the one where most of us play, we're not seeing a lot of these companies yet at new highs, but we are seeing some. There's actually a couple on this panel that are at new highs, and again, it's so far it's largely been companies that are, you know, either farther up the food chain for the juniors, in other words, development level companies, ones that have feasibility studies, ones that are literally on the road to production and construction. The other group that seems to be getting a lot of benefits so far is higher grade stories. Investors seem to be drawn quite often to these high grade stories anyway. We're starting to see move in what I call optionality plays, and that's lower grade, and in some cases completely uneconomic even at current prices, but very, very large deposits. There's a number of these companies, a lot of them are well known. We're starting to see those move now. I've had a lot of conversations with a lot of CEOs lately. Many, many, many of them are starting to get calls from generalist investors. And when you think about how bad things are going to be in terms of supply shock, demand shock, drop in sales, drop in revenues for most of the sectors in the economy, I expect most of them to do quite badly this year. You know, Fed or no Fed, it's not going to save them. I think that we'll see the gold sector is ironically, and I think for the first time in I don't even know how long, a very, very long time. For the first time in a very long time, the gold sector I expect to probably be the best performing sector in the entire market in terms of revenue growth and bottom line growth. And the simple truth is, when you get a sector behaving that way, it draws a lot of generalist money. And what happens is you've got a lot of funds, a lot of institutions. They basically live and die in their quarterly reports. And you've got a lot of these guys looking around right now. As we start seeing, especially Q2, I think that's where you're going to see the real. We've already seen some pretty damn good Q1 numbers from some of the miners. I think they're going to be significantly better in Q2. And that's when I think we're going to see a lot more generalist money and funds basically saying to their traders, get me 50 million in gold stocks. I need to show 2 or 3 or 4 or 5% of the fund is in this sector because it's a winning one. To which the trader will probably say which gold stocks, and the fund manager will probably say, I don't give a shit, just buy some. I don't care as long as they're gold stocks. That's why you're seeing, in terms of new breakouts and all, you know, they're not all-time highs yet, but they're multi-year highs for companies like Barrick and Newmont. That's where these guys go first. They go to the biggest, most liquid names that they've all heard of. It takes a while for that money to filter down, but it is starting to filter down now. That's one of the reasons I expect this to be a very, very good year for the juniors. So at the end of the day, I mean, we don't know what the economic impacts of COVID are going to be, except that I think they're going to be longer lasting and worse than the market's pricing in right now. And that's not even because I'm negative about the virus per se. I mean, I do think we're starting to come out of it, but I just think a huge amount of damage has been done. So we've had the Fed expand their balance sheet to 10 trillion. Washington's got a 3 or 4 trillion deficit, and percentage of GDP terms and numbers are as large or larger for virtually everybody in the G8. We're all in the same boat here. The question is, and this is part of the reason why I expect this particular gold market to probably be a long-lasting bull market. What we don't know, and I don't think anyone knows this, is what's the end game? What's the exit? I don't think anyone has the faintest idea how they come out of it. There was a Fed meeting yesterday, and I'll give Jay Powell, the chairman of the Fed, credit for being honest when he basically just said, "Look, it's just not my problem right now. I don't care what the exit is. I'm worried about keeping things from falling apart. And until I'm comfortable that we've gotten past that stage, I don't have to worry about that anymore. I'm not even going to think about what the exit is." You know, that's alarming at one level, but it's music to my ears as a gold investor, because that tells me that this uncertainty and this desire to have non-financial system assets is probably going to go on for a while. I don't personally think, especially in the U.S., I don't think it's possible even in most of the Eurozone countries, but definitely in the U.S., you're talking 10 trillion in added government liabilities this year. I do not see any feasible way, either through cutting the budget or increasing taxes, that's going to make any kind of a reasonable dent in that, even if you're looking at it as a 10-year plan. I just think it would be political suicide. There's no way you're going to see that happen in the near future. I think there's a real potential for an MMT, a modern monetary theory, as it's called, sort of solution. And essentially that would essentially involve the Fed printing $10 trillion and buying all the treasuries off the U.S. Treasury and then running them through the shredder. That horrifies hard money guys. Could they do it? Sure. I don't see why not. Do I personally expect we'd see the dollar collapse that everybody keeps predicting? I'm not convinced we would, honestly. I suspect, Sorry, hard money guys, but I think the U.S. has probably got a lot more room to undertake that kind of operation than people think before the dollar falls apart. It's still the world's reserve currency, and I don't see that changing anytime soon. I do think it will change. One thing that scares the Fed, and I think if the Fed is any nightmare scenario right now, I mean, aside from a bond market collapse, it's essentially the U.S. dollar having the kind of run that a lot of market observers have been calling for the last couple of months. And by run, I don't mean from 99 to 105 on the index. I mean 99 to 160 or 170 on the index. I know a lot of guys that are actually expecting to move that large. If that happened, it would blow the markets up. It would completely blow the markets up. Then you would absolutely see a crash on Wall Street if that happened, and probably every other bourse across the world. I think the Fed and other central banks are going to do everything they can to keep that from happening. I'm not personally convinced that that's a realistic scenario. I don't personally see that kind of a move. I think we could see a move higher in the US dollar. I don't think it's going to be as big as some of these dollar bulls are calling for. Basically, the concern is there's a worldwide shortage of dollars because so many entities outside the US have borrowed in US dollars, and they simply don't have the currency to pay back those debts. I think you'll probably find, we're going to see other central banks come up with workarounds the way the Fed's come up with so many in the last 2 months. I think, they're not going to let their national champion companies go under based on that. I mean, they'll find some way to funnel US dollars to them. The Fed's had a lot of success so far with things like swap lines. And one thing that I always try to remind people is when you look at the US, most people, especially Americans, tend to forget that the U.S. is not actually a creditor country. It hasn't been a creditor country for a long time now. It's actually the world's biggest debtor nation. That means there are a lot of U.S. assets in the hands of overseas holders and investors. And part of the reason why the dollar running is a nightmare scenario is that if it happens, the Fed's well aware of the fact that the likely outcome of that is going to be offshore entities dumping U.S. assets in order to create U.S. dollars. We've already seen a lot of money get pulled out of the treasury market by offshore investors even in the last month or two. I think that's why you saw those swap lines get created, because the Fed, of course, is a custodian for a lot of those holdings, so they better than anyone knew that selling was happening. I think they brought the swap lines in because they were worried about essentially a crash, which would drive yields higher on treasuries. So I think they're just going to do whatever they have to. I think we might see a slightly higher dollar, but I'm not convinced we'll see it high enough that it's going to have an impact on the gold price that's going to overwhelm the larger macro scenario that we're in. So, bottom line, what do I think happens here? Given how good a job the Fed has done of maintaining the Fed put, I'm not sure. Wall Street might not literally revisit its 2100 lows. I think it probably will. I think it rolls over at some point in the next few weeks. I'm not expecting a crash. Again, I'm expecting a scenario much like 2009, when it became clear that a lot of job losses would be long term, and a lot of people are losing their houses, et cetera, et cetera. It wasn't so much a crash; it's kind of a slow grind lower. And I think if it rolls over, we're going to see the same thing. I could see the S&P going back to its March lows, but it won't do it in a week. It'll do it in 6 or 7 months. And that's a scenario that's not going to have a big negative impact on, say, smaller markets and juniors, as long as the gold price is holding up. It's crashes that make liquidity vaporize everywhere. Long kind of grinding down slopes don't have that impact. The impacts, are obviously going to be tougher for those at the bottom part of the income scale. The Fed's, as usual, done a great job of saving the 1%. Not doing too shabby a job saving the 10% too. The other 90% are the ones that have the problem. And the impacts, and they're very hard to gauge because I don't think a lot of these people get picked up very well in most of the economic readings. It's basically those with lower skilled and gig jobs. Those are much tougher to digitize. It's much tougher for them to be sitting in their dining room doing a webinar, say. I mean, they've got hands-on jobs. I think a lot of those jobs are going to get lost, and there's going to be a lot of knock-on effects. I don't think we've seen the end of problems in the debt markets. We're barely at the point yet where people are technically overdue on their car loans and their mortgages and stuff. That's all coming. We just have to see how the Fed deals with that longer term and who they end up saving. We're just, and that's what I call the insolvency phase, that long, slow grind, and we're entering that now. The insolvency phase also tends to be quite good because you tend to have very muted interest rates and a very muted general market. It also tends to be quite good for gold, and it's generally pretty good for resource equities. I think, I think we're going to have to wait for a bunch of numbers to pile up for that to happen. But essentially, the backdrop we're in right now, and that I see going forward on Wall Street, relatively weak equities, Fed keeping the yields forced down, and concerns about some kind of reset that no one knows what form it's going to take. Everybody's thinking about having outside of the fiscal system assets. This is basically a perfect backdrop for gold and for gold equities. If you were going to design a backdrop that would be positive for gold, this is pretty much what you come up with, short of the virus, obviously. But still, it is what it is. I think this is the right place to be in the market for certainly the rest of the year and probably longer than that. I think the gold sector is going to do very well. And I'm now going to start introducing you to some gentlemen that run companies that I follow in the newsletter, all of whom are seeing, they're seeing gains on discovery, and they're also seeing gains because they've got good precious metal assets. Just to throw you a curveball, I'm going to start off with a copper asset, not a gold asset, but nonetheless, this is the other type of stock that I think can do well in any market, and that's a discovery story.